All right, guys and gals, boys and girls, today I thought what we would do is actually analyze a deal. I don't want to go with some really complicated deal, apartments, offices, retail. I thought we'd go with a very simple deal here, and what we're going to use today is actually the Bigger Pockets buy and hold tool. It's on their website. I'll put a link below. Let's get into it. Okay, so we're gonna analyze a deal here. I have a deal that I did a few years back. This was one of the older deals I did. And what I did here is I put it in Excel, put some of the details, kind of the income, the expenses. I thought I'd use this to run you through the actual Bigger Pockets calculator. So check this out here. So biggerpockets.com // buy and hold. This is one of many calculators that they have to kind of have a first back of the napkin look at a property. And it's not being fair to it saying back of the napkin, because it does go into quite a bit of detail. So I thought we'd go through one of those. If you're interested in more complex calculations and kind of what I use for more complicated deals, this is something that I've kind of put together over the years of different models that have worked better than others. And this is like a full discounted cash flow for apartment that we bought. So, you know, this is getting more into the internal rates of return. We're looking at debt service coverage ratio. You know, just the things you need to do when you're looking at commercial property, a few more moving parts. So let's get back to our simple calculation. So this was a single family home. I actually started inputting some of this. So let's call it Jesse's, spell that properly, Jesse's property, 123 Fake Street. Let's get them, boys. If you know that reference, congratulations, you were born in the 80s. Okay, so Waterloo, Ontario. How dare you ask me for a state, Bigger Pockets? We are in the land of provinces. Okay, so I'm gonna start inputting this stuff. I'm gonna zip by here and just so we don't bore anybody. So check this out. So this is the property tax, 2805. So I'm gonna go back here. I'm gonna put 2805. You can add a photo, fantastic. Add a property sales description, great. Not gonna use it for our purposes. Go on to the next. Now I should say, if you're looking at a flyer, say, or you're in LoopNet, or your broker gave you an off-market deal, this is where you would be going to input all this information. So the purchase price, as we mentioned, $255,000. After repair value, this is gonna be the same as the purchase price, only because we're not doing anything to it. That's another cool feature of this, that you can actually do that. You can actually put in a repair cost, but for our purposes, not needed. Cash purse, sorry, just make sure these are all right. Yep. Estimated, yep, so no repairs. Cash purchase, of course not. What would be the point of real estate if we weren't gonna lever these up a little bit? Where's the fun in that? Okay, so 10% down payment, loan interest. I think at the time it was 3.94. Don't get mad at me if your market isn't that. This was a few years ago and you're probably in a different market. Other charges, points charged by the lender. I'll just make a quick note here. Most lenders will charge something like 1% of the total value. Usually at closing. And in this case, I'm not doing it because these smaller deals, a lot of times you'll go straight to your bank and there won't be a fee. I should also mention that 1% fee, sometimes it's at closing that it's paid, sometimes it's rolled into the deal. So I'm just gonna make a note of that. But for our purposes, let's leave that. Interest only, no. Amortization, let's go 25 years. You can go 30 years, 35, depending on your market, depending on what's allowed. Simply put, shorter amortization, you're paying more of the principal. Longer amortization, you're paying more the interest as a percentage of your payment. Some of you savvy people out there are saying, well, if it's tax deductible, the interest is okay. Not a bad argument, not gonna debate you. Yeah, you're probably right. A longer amortization, if everything else still makes sense in the deal, not a bad idea. Okay, so typical cap rate for the area, I think at the time, I want to say 6.5%, something like that. You know, you go to any brokerage online, commercial brokerage will give you the prevailing cap rates in an area. Again, single family homes and smaller properties, they're just a little harder because there's not as much data that's, you know, collected like the commercial firms will collect. Okay, so here's the fun part. The scheduled income was $2,750. Other monthly income, no laundry income. Electricity, that was, I believe, $300. Water, let's call that $200. I'm just kind of going by memory. I think they were fairly close and I had some of these already filled out. HOA's monthly insurance, we're gonna leave for now. other monthly expenses. So before we go there, that's your income. However, most markets will need a 3%, 5%, or even higher percentage vacancy, because as much as we love our properties to be full all year round, they just aren't. So this gives you a little bit of a buffer for when you do go vacant. Repair and maintenance. R&M is a controversial topic in real estate. Underwriters will underwrite large properties at say $500 to $700 per unit, say an apartment building, for repair and maintenance. So if it's a 10-unit building, that's $5,000 to $7,000 a year. That, if you've run a property before, is almost always wrong. It's usually much closer to 1,000, if not higher, per unit. These smaller properties, you'll hear people say 1% to 3% as a metric. It's really tough. What I want to do here is I want to keep this blank here, because these variable expenses are broken down on a monthly, as a percentage of your monthly rent. I want to keep it simple that repair and maintenance, say it's 1% of the purchase price, so $2,500. So we're going to go roughly $200 a month, but I'm going to bump that to $300 because I know I also had a landscaping and snow removal company. So let's just put that there for now. If we really wanted to be particular, we could, spell everything out. Capital expenditures and management fees, I'll just briefly touch on this. CapEx, also known as CapEx reserve, capital expenditure reserves, the amount of money that you'll put away because you'll have capital expenditures from time to time. And a perfect example is a roof goes. In reality, you pay for all that roof in one time. From an accounting perspective, you amortize that cost over time. So when you're doing pro formas, it's much easier to put a reserve in there for capital expenditures, so it smooths out those big expenses that happen in one given year. So we're gonna leave that. Management, that could be from 5 to 15%. We're gonna do the silly thing that I did and manage it on my own. You're not silly if you manage your own. I just was silly. Okay, so here we go. Annual income growth. Let's go 3%. I'm using 3% just because every market's different. Some markets have rent control where they actually can't raise rent until people move out. Let's just use 3% for now. PV growth. This is the actual growth of the asset itself. So how much the property goes up a year. Don't use a number, that you just had a really good number last year, like you're in California, San Francisco, and use 20% here. You want to use an average over a long period of time. For my market, let's call it 4.5%. Annual expenses, let's go up 3%. My dad says everything's getting more expensive. Sales expense. So sales expense are really just your closing costs, brokerage fees, legal fees. Those are fairly static. I don't think that broker fees have gone up much in terms of percentage of valued properties. Let's call that 1%. Okay, so this is all filled out. Boom, calculate. Okay, so not a bad looking, result here. So if we look at this, let's go through this. So you had the monthly income here, monthly expenses, cash flow, 7.2% cap rate. What is that cap rate? That's just basically the yield. Okay, that is your unlevered without debt yield for the property. So cap rates are great only if you're comparing it to something. If you say 7%, okay, that's great, 7% return or yield on your money. But what does that mean? Is that good? If you're in California, that's ridiculously good. If you're in Buffalo, that's probably pretty bad. So they have to be used as a comparative tool. And this whole thing has to be used as a comparative metric, because that's the whole point. When you're looking at properties, you're comparing properties to seeing which ones. So you have a baseline for what you want, what kind of performance you want. Like you need positive cash flow, but how positive? This cash on cash return, does that make sense to you? For those of you that don't know, the cash on cash return is dividing the annual cash flow. So 329 times 12. Okay, so I don't know what that works out to. That's probably 3,800 or something like that. So we're closer to 4,000. Divide that by the cash needed, the cash you invested. So basically, what was the return on the actual money you took out of your pocket and put into this deal? Let's go down a little. Oh, this is actually cool too. We should touch on this. This is actually what my accounting software, this is close to what it looks like here. So that's pretty cool. And we go down further, and this is really where we put in the increases. And I think that if you look at this annualized return at the bottom, I'm not 100% sure because I didn't ask the guys at Bigger Pockets, but I'm pretty sure this is an internal rate of return. So for you finance folk or economic folk out there, that is your, basically it's your total return with smoothing out all of the cash, the irregular cash flows and cash outflows. So it's a great, very important metric. I can definitely do a video on that because that's a key metric when you're looking at deals. And it has this funny little feature that after a certain point, you see the IRRs, actually, they call them sinking IRRs, that they go down. Because what that tells you is that you've got everything out of this investment, you want to repatriate that capital and use it for something else. Don't want to get in the weeds here. So anyways, just a very cool output. So I think this is something that, you know, you can definitely get use out of. You know, you can research the 50% rule on Bigger Pockets. It's another cool little feature. But yeah, so I thought, you know, I'd show you how to run through a deal. If you have any questions, if you want me to drill down on anything in more detail, don't hesitate to reach out, and I'll meet you back on the other screen. All right, everyone, I hope that is clear as mud now. Like I said before, we're gonna get into a little bit more complex deals when you're looking at expense reimbursements for offices, apartments, all this stuff. It's all fun. We'll get to that point. That's it for me. Like, subscribe, leave a comment. If you wanna see a video specifically, leave a comment and let me know below. Signing out. Take care, guys.